Welcome to the Explainer. Okay, today we are tackling something that's notoriously confusing, but honestly, it's absolutely essential if you're ever planning to buy a home. We're going to look at the true costs of a mortgage, pulling from some really fantastic educational material from Believe Home Loans, Inc. My goal today is to completely shift how you think about getting a loan. By the end of this explainer, you aren't just going to understand the jargon, you're going to be equipped with the exact financial frameworks you need to make the smartest possible choice for your wallet. Okay, let's dive into this. Here is our roadmap for today. First, we'll look beyond the interest rate. Then, we'll unpack upfront mortgage costs. From there, we'll find your break-even point, explore your mortgage options, demystify how rate locks work, and finally help you make a truly informed decision.
Section 1. Beyond the interest rate. We really need to look at the total cost.
You know, when people start shopping for a mortgage, almost everyone falls into the exact same trap. They fixate on just a single question. What is the interest rate? And look, it completely makes sense why we do this, right? The interest rate is a massive factor because it directly controls your monthly payment. A lower rate generally equals a lower monthly payment, and a higher rate means a higher payment. It feels like the ultimate finish line. But relying solely on this one question, it's incredibly dangerous for your long-term wealth.
We need a major paradigm shift here. We literally have to move away from asking, what is the interest rate, and start asking a vastly more important question. What is the total cost of this loan, and does this rate actually make sense for my specific situation? You see, sometimes the absolute lowest rate out there hides significantly higher upfront costs. If you aren't looking at the total picture, that cheap rate could end up costing you thousands of dollars more in the long run.
Moving right along to Section 2, unpacking upfront mortgage costs. Let's strip away all that jargon. To actually understand the total cost of a loan, we got to look under the hood. First up, we have origination fees. Just think of these as the cost of doing business. These are the charges connected to arranging, processing, and actually funding your loan. You'll typically pay these right at the closing table, and they are required to be clearly shown on your official loan estimate and your closing disclosure. Now, it's absolutely crucial to understand that paying origination fees doesn't automatically mean you're getting a lower rate. It's simply the operational cost of the loan itself.
But then we have discount points, and this is a whole different ballgame. Discount points are upfront fees that you actively choose to pay in order to reduce your interest rate. 1 point usually equals 1% of your total loan amount. So in plain English, you are paying more money out of your pocket right now to try and save money on your payment every single month later on. It's a trade-off.
So, Section 3, finding your break-even point. Is paying upfront actually smart? Now, what's really interesting about this math is how we figure out if paying thousands upfront is actually a smart move. Let's say you're taking out a $300,000 mortgage. If you want to buy one discount point to lower your rate, well, remember that 1 point equals 1% of the loan amount. That means you're writing a check for an extra $3,000 upfront.
Let's walk through the logic of this step by step. Step 1. You pay that $3,000 upfront at closing. Step 2. Because of that lower rate, let's say you save exactly $100 a month on your mortgage payment. Great, right? Well, step 3, to find your break-even point, you divide the upfront cost by the monthly savings. 3,000 divided by 100 equals 30, meaning it will take you exactly 30 months of living in that house, making those lower payments, just to recover the initial $3,000 you paid on day one.
And here is the absolute kicker, guys. If you sell that home, if you refinance the mortgage, or if you somehow pay off the loan before you hit that 30-month mark, paying for that lower rate was a bad financial decision. You won't have recovered the extra costs you paid up front. If you stay longer than 30 months, it might be a brilliant move. But this right here is exactly why blindly chasing the lowest interest rate is not always the best path.
Section 4. Exploring your mortgage options. Let's design your perfect loan.
Now that you get how upfront costs and monthly savings dance together, you literally have the power to design a loan that fits your life. You generally have a spectrum of 3 choices. Option 1 gives you that lower rate but requires higher upfront costs and a lot more cash at closing. Option 2 offers a slightly higher rate but much lower upfront costs, which keeps your hard-earned money in your pocket today. And Option 3 offers a higher rate, but it might actually come with a lender credit that helps pay your closing costs. There is no universal right answer here. The best choice completely depends on the cash you have available today, your monthly budget, and realistically, how long you plan to keep this specific loan before selling or refinancing.
All right, Section 5, how rate locks work. Let's protect against that volatility.
Financial markets are constantly moving, right? That means your pricing structure can literally change daily. Mortgage rates shift based on the bond market, inflation data, all sorts of economic news. So a rate lock means the lender is holding a specific rate and cost structure just for you for a ticking clock time frame. This could be 15, 30, 45, or even 60 days, depending on your lender and your timeline. It essentially acts as a shield against market volatility while you finalize your home purchase or refinance.
But please, do not just make assumptions here. The rate shown on your initial loan estimate might not actually be locked. You must always look at the very top of page 1 of your loan estimate to verify whether that rate is secured and exactly what day and time that lock expires. If it doesn't say it's locked, you are still floating out there on the open market.
So the crucial point is understanding that a lock is an awesome protective shield, but it isn't magic. It's based on the facts you presented at the time. Even after you lock, if the foundational details of your loan change, like, say, your loan amount shifts, your credit score drops, the home appraisal comes in low, or you completely change loan programs, well, your final rate and cost structure might still need to be updated. The lock only protects you if your initial facts remain exactly the same.
Which brings us to Section 6, making an informed decision. Let's translate this to action.
We've covered a ton of ground today, and now it's time to see how this builds your confidence. When it's finally time to lock, do not just blindly accept the first piece of paper handed to you. Ask these exact questions. What is the total upfront cost for this rate? What would my payment look like if I took a slightly higher rate? Can you show me an option with a lower upfront cost or maybe even a lender credit? And most importantly, if I buy points, what is my exact break-even timeline in months? Seriously, a true professional will gladly walk you through these comparisons.
This leads us to a really fantastic summary quote from the source material. The most educated mortgage decision is not simply choosing the lowest rate. It is choosing the best overall structure for your financial situation. It's all about balancing your cash to close, your monthly payment, and your big picture long-term life plans.
Now, before we wrap up, I do need to share a quick educational disclaimer from our source material. Believe Home Loans, Inc. is a mortgage broker, not a direct lender. This explainer is strictly for educational purposes and is not a commitment to lend, a guarantee of loan approval, or a guarantee of any specific interest rate, cost, or loan term. Rates, fees, and loan options are always subject to market conditions, borrower qualifications, property details, investor guidelines, and final underwriting approval. Always, always review your loan estimate and closing disclosure carefully before making a mortgage decision.
So I leave you with this final thought to chew on. Now that you've seen the hidden math behind the curtain and you truly understand the massive impact of break-even points and upfront fees, the next time you're in the market for a home, are you going to blindly chase the lowest rate, or will you step up and design the perfect mortgage structure for your exact timeline? The power is completely in your hands now. Keep asking the right questions and keep learning.